Okay, and we are live from New York. It's Mitch Goldberg, financial advisor with the wealth management firm Client First Strategy. You're watching Be the Boss of Your Money. I used to say late edition, but I'm doing this every day at 4:30, so now it's the regular time. And I will be here every day, especially so I can help you navigate through this crisis that we're in. We are going to get through this, folks, believe it or not. And that's my message today, and I've got some reasons why. And were buybacks all these years since the Great Recession ended, did that just turn out to be a complete and total waste of trillions of dollars? And why? What happened to the volatility? The market was up like 100 points. Where's the giant swing? Where's the up 1,000, down 2,000? What's going on here? And most of all, what's the difference between the different kinds of consumer stocks? You hear about consumer this, consumer that, consumer stocks. Not all consumer stocks are made the same. We're going to get into that. And I want you to stick around because it's very important that you know the difference. This is about personal finance, investing, being better with your money, financial decisions, and most of all, just to make you better off financially so you have a better shot to reach your financial goals. But first, let's cue the introduction. By the way, you notice I have cats and dogs behind me because what could be more calming than cats and dogs? And that's the kind of day it was today. Let's get into the introduction. I'm doing it. Where is it? It's like something from this day is missing. What's missing? Oh yeah, the volatility. The Dow was like barely up today, but that's good news. Remember, if you tuned in yesterday, I said, we don't get flat days. We get big swings, either up big or down big. And that's not the kind of day we had, thankfully. It's a day to sort of reassess. It was like, you know what today felt like? It felt like the good old days. It felt like a normal day in the market. It felt like a day you can breathe. It felt like a day that you could actually stop, think, reassess, and make some smart moves. Because making moves when you've got a ton of news coming at you, a ton of information coming at you, and you can't even think straight, that's not the best time. The best time to make a move is after you've had time to consider what's happening, consider the news, do some deep contemplative thinking, and then you make your moves. And I heard something today. I don't want to get into it because, I never know who's watching this, but a friend of mine, I'm trying to choose my words so carefully, but a friend of mine said his financial advisor said, sell half your stocks now, and we'll buy them back in 3 weeks. And, to me, I make decisions for my clients based on their time horizon, their risk tolerance, their age, their financial goals. Usually people have more than one goal, by the way. And it's not just a matter of just a simple asset allocation. Sometimes you have bonds or, bond ETFs that mature at a certain date and time to help fund a goal. An investment plan is more than just an asset allocation model and just a bunch of investments that you buy and sell. There's a lot more to it. And my reasoning to this fellow is, hey, I know about your potential inheritance. I know about the equity you have in your house. I know about your income, your money in the bank. I know about your retirement plans. I know about all of your assets. And we went to about 45, 50%, 50-50 stocks, bonds almost a year ago in anticipation of a bad thing in the market happening. Hey, I'm not Nostradamus. I didn't know for sure. I didn't know that we were going to have this coronavirus. No. But what I do know is that at a certain age, you dial down your risk because you just don't have the time horizon in front of you like you used to when you were younger. So that when you have a down market, you don't go down as much. You don't have the time to wait for things to recover. You're not investing as much in your 401k anymore. In fact, you're ending your contribution years into your plans, and you're going into the distribution years of your plan. So just want to throw that out there. I don't like all or nothing investment plans. It's not a plan. It's not a strategy. Maybe somebody on TV who's trading on technicals. I'm not knocking anyone on TV. I've been on TV, but I'm not knocking anyone for being a hedge fund manager or somebody that's just a day trader. No problem. If that's your style, then good for you. But I know that for the people watching this presentation, for the people who are using me as their financial advisor, this, by the way, goes for all the financial advisors in my community. I've got a great community of the most incredible financial advisors all over the country. And I'm really grateful for that, because we talk to each other, we share content ideas, we direct message each other. It's really just a remarkable thing. I mean, 15, 20, 30 years ago, that was unheard of. But today, I think in my life, it's common, and I'm very happy about it. So anyway, today was a low volatility day. It was like something was missing. And I could hear the jokes. Yeah, my hair is missing. Before this whole coronavirus thing started, I really wish that I took the time to get a haircut, because now I can't get a haircut. When your hair is like starting to thin, the hair over here starts to kind of grow out, and seems like it grows faster and it's thicker. And after a while, you start to look like, Bozo the Clown. So I'm trying to, get down, trying not to let that happen, but it's going to start getting poofy up there. So hopefully this thing goes away so I can get a haircut, but I'm not getting a haircut. I don't think my barber's even open, but I digress. I want to get my phone. I know you're not supposed to leave the camera, but I should have had this in my hand. First of all, I dropped my notes. I'm back. I have my notes. Okay. That's what happened. Look, that's the beauty of a live presentation. These things happen. Hey, this is not a TV studio, okay? This is not supposed to be something super polished. It's supposed to be authentic. Okay. So where's the volatility? The VIX dropped from about 75 to the high 60s. That's a way that on Wall Street we measure volatility. And it's come down a pretty nice amount. I mean, it's still super elevated because people are still scared. They don't know what's going to happen next. So why did the VIX go down? Why was it a pretty flat day? Well, oil rebounded over 20% today. So it's had its best day in like forever. So oil stocks got too beaten up. Another reason is you have to think of it this way. I made a real doom and gloom presentation if you were here on Monday. And I went into a worst case scenario about what can happen with the coronavirus, the economy, the human toll. I'm not going there today. And I never said it's the most likely situation. I said it's a worst case scenario where you really have to let your mind extrapolate all the bad news. And that's sometimes something we do. And my point was, I don't think we go there. And I did say in that presentation that I am now a buyer of stocks, of certain stocks, exchange traded funds as well. I said that on Tuesday. I reiterated that yesterday, and here we are, and I'm still reiterating that. Not crazy in what I buy for clients. I take a portfolio approach, and I want you to do the same thing. Don't just buy a stock because it's down and you expect to pop up. Make sure it fits in with the rest of your portfolio. This way, if you're wrong and the market does turn tail and go down again, or the stock that you bought drops, at least you won't be second guessing yourself to death, and you'll realize that what you did was the right move for your overall portfolio. If you can think in like that, make portfolio moves, not just a stock by stock basis, I think you'll be a lot better as an investor, and I think you'll be able to be a lot calmer, kind of calm the way the cats and dogs should make you feel. Because today was a super calm day, so that's why I have the cats and dogs. I love cats and dogs. I also love bearded dragons. My son has a bearded dragon. He's so cute. He's like the family pet. Okay, so that is where the volatility comes from. The lack of volatility today. Have you considered that things could go right, that maybe we don't get the worst case scenario with the coronavirus? Have you considered maybe we don't get the worst case scenario in the economy? Have you considered that there are a number of drug trials, vaccine trials that are taking place right now? There's a number of drugs on the market that could be useful. Have you considered that the Fed and the government are pumping in so much stimulus and so much money into the system to help stave off a really nasty recession. That means when we come out of this coronavirus thing, this crisis, stop and consider how quickly things can come back and how great they could do with all this money sloshing around and low interest rates. We could have such a juiced up economy coming out of this. I think it would be great for the economy. I think it would be great for the stock market. This is why I don't like all or nothing decisions. This is why I don't think you should sell everything and try to buy it back later. The idea with selling or selling half your portfolio, some magical number, the reason it doesn't work for me is because if you decide you're going to get back in and now the market's up, you're going to say to yourself, nah, I could have gotten everything lower, so I'll wait. I'm just going to wait till things go back down. And then things go back down and you say to yourself, things are going lower. I'm a little afraid. I'm a little nervous. I'm going to wait because things are going lower. And then things go back up and you say, I could have had things lower. And you wind up just in an endless state of procrastination. And you forget that investing is owning and patience. Owning and patience. And then time goes by. In the meantime, inflation is still eating away at your cash. The investments recover. They could pay dividends. You could reinvest the dividends. Corporate managements are doing everything they can to grow and be mean and lean, and you're missing out on that. But the volatility in the market, down markets, that's the price you pay over the near term for gains over the long term. Okay? When we say that the stock market has an average return of about 9.5% annually over, let's say, the last 50 years, or 70 years, we never get an actual average year. It's just the compilation or the averaging out of all the years before it. And you get that by being in the market for the long term. It's not timing the market, it's time in the market. And I don't think most people can really time the market that well to get out now and just get back in at another time. Okay, buybacks. Have buybacks been a total colossal waste of money? I'm going to share something with you, okay? Because as of yesterday, at the lows, we were about 4-year lows. So the entire gain of the last few years has disappeared. And today the market was barely up. So it's we're down about 1,300. So got a little bit back today, a tiny bit. The buyback, the Spider buyback ETF. I'm not going to say the symbol because these are not recommendations. These are examples of buybacks, okay? And I'm using an ETF as an example, the returns. Down 36% this year. The S&P 500, which is an index, as you know, you cannot invest directly into an index, but you could invest in a stock that mimics or tracks an index. That's down about 25% year to date. But the an exchange traded fund that I use, it's it invests in dividend achievers, companies that consistently pay and grow their dividend. That's down 20%. I've been against buybacks for a long time. I have proof. Darn it! You know what? I really need to get better at this paper thing. So here, let me just show you this, okay? I wrote this for CNBC about a year and 3 months ago. The title is, I don't know if you can see it from there, okay? Investors should be furious. 3 blue chip stock buybacks that went horribly wrong. And in it, I talked about Citigroup, GE, and IBM. GE is back down to like $6 a share. IBM is back down to 100. So all the buybacks, what did it get you? Citigroup did a 10-for-1 reverse split after the Great Recession. So when you see how high the stock is, you have to realize that if you took away the reverse stock split, the stock would be still trading at 1/10 of where it is. Okay, and then now you look at airline stocks like American Airlines, and they want government cash. They want a bailout, but they spent a lot of money on buybacks. And the reason I've been railing against buybacks, and I've written other articles for CNBC about the same exact topic, is because there comes a time when they might need the money. as consumers, we're told to have 6 to 12 months of savings, or at least 3 months of savings in the bank, of living expenses. These companies didn't do that. Not only did they spend their cash in buybacks, because, the market was so great, they actually some of these companies took on debt to do the buyback. So since the Great Recession, well over $1 trillion spent on buybacks. And where did it get us? What good did it do us? So I saw today that if Boeing and other companies do receive government bailout cash, that President Trump is definitely open to disallowing these companies from any buybacks. I happen to agree with that. Now, that might be a little, people could think, yeah, but that's not capital. That's not free markets. Well, neither are bailouts. Corporate bailouts are not capitalism. Capitalism says, hey, they messed up, these companies, they should go out of business. We don't want that to happen, because millions of people will lose their jobs, and it'll be a real hit to the rest of us. So we bail them out. They pay a penalty, just like the banks did. They pay the money back, and then we go marching on to the next crisis. The problem with the buybacks is companies spent their cash wad on buybacks, which turns out did not help the price of their stocks. They call it returning cash to shareholders. I'll take a dividend any day of the week over a buyback. Some people say, they say buybacks are more efficient because there's not a taxable event from a buyback, but from a dividend, you have to pay a little tax. I'll pay the tax. I'd rather get the dividends and reinvest, or keep the cash dividend myself, as opposed to the buybacks. Well, as far as taxes goes, I'm not a tax advisor. If you have any questions about taxes, you should consult with your own personal tax advisor, just to make sure I get that disclaimer. Okay. So what else is on the agenda? Something you need to know, because you're hearing about stocking up and hoarding of toilet paper and paper towels and Clorox wipes. So when we talk about consumer stocks, I want you to take this really seriously, because you need to know that there are two major categories of consumer stocks. One is consumer staples. Okay, consumer staples are things that you need, like toilet paper and toothpaste and food. Okay, and then there's consumer discretion. Consumer discretion are consumer products that we really want, but we don't need them. Now, I know that if there's something you want badly enough, it will become a burning need for you, a burning desire. But basically speaking, consumer discretion, like jewelry, for example, like expensive coffee, these are discretionary items. You don't really need them. You just want them a lot. Okay, that's the difference. So if you take a look at the major ETF that tracks the consumer staples sector of the market, it's down 14% on the year versus negative 25% on the S&P 500. So it's holding up a lot better. And in this ETF, which is basically tracks an index of consumer staples, the biggest stocks in it, among the biggest stocks, are Procter & Gamble, soap, laundry detergent, Walmart, and you see how well Walmart's doing now, and Mondelez. Mondelez makes a lot of food products like Oreos, for example. And then you take a look at consumer discretion, and the consumer discretion index is off 27%. Again, it's 13 percentage points worse than consumer staples. And in that, it has companies like Nike, Starbucks, and Amazon. I mean, to me, Amazon, I think, could go either way. There are some companies that straddle both consumer discretion and consumer staples. It's not up to me. I don't determine these. These are determined by the S&P division of McGraw-Hill. So that's what this episode is all about. So the next time you hear about consumer stocks, keep in mind that they're not all the same. Keep in mind that consumer staples hold up better in a tough economy, a recession, a bear market, and consumer discretion does better when things are really good and unemployment is low and people are making money and they have the discretionary cash to buy their toys. Okay, that's what consumer discretionary does. So the last couple of years, it's been great for consumer discretionary. And now that people are worried about a recession, people are flocking more toward the consumer staples because that's what people are hoarding right now in their houses. So to sum this up, think about this. The worst case scenario is starting to get factored out. I think what's happening is investors are starting to look past the valley, past a potential, what we do expect to be a nasty but short-term recession from the coronavirus. And investors are starting to look past that. And they're saying, hey, you know what? Things might turn out better than we thought. We might actually get through this. And with the government intervention, stimulus, monetary policy, fiscal policy, things could actually be really good on the other side of this really swift bear market. And that's why volatility today took a break. And we had basically a very calm day, like the cats and dogs behind me. I'd like to thank you for watching. If you have any questions, hit me up, please, in the comments. I'm not going to check the comments right this second because I really want to get this presentation in under 20 minutes, and I am over 21 minutes already. I'll speak to you tomorrow, and I'll answer all of your questions in the comments tonight. Thank you very much for watching. I really appreciate it. I'm going to end the broadcast.